Imagine your kitchen bustling with fresh ingredients, but do you truly know the precise value of everything stored in your pantry or freezer at any given moment? Understanding this is vital for every food business, from a cozy cafe to a large restaurant chain. When it comes to calculating the value of your inventory, there are three common and widely used methods. First in, first out, often called FIFO, last in, first out, known as LIFO, and the weighted average cost method. Let's explore FIFO first. This method assumes that the first items you purchased are the first ones you sell or use. Think of it like rotating your stock, where older produce or ingredients are moved to the front to be used before they spoil. For food businesses, FIFO is often the most logical and practical choice, especially for perishable items. This approach results in your ending inventory being valued at the cost of your most recently purchased goods. In times of rising costs, FIFO generally leads to a higher reported gross profit and a higher inventory value on your balance sheet, because the lower cost of older inventory is matched against current sales. Next is LIFO, which assumes the exact opposite. The last items you purchased are the first ones you sell. While this might seem counterintuitive for food items, it's a method used by many businesses, particularly in industries where inventory is homogeneous and not perishable, like piles of coal. With LIFO, your ending inventory is valued at the cost of your oldest inventory. During periods of inflation or rising costs, using LIFO typically results in a lower reported gross profit and a lower inventory value on your balance sheet. This is because the higher cost of recently acquired inventory is matched against sales. It's important to note that while LIFO is permitted under United States Generally Accepted Accounting Principles, or GAAP, it is not allowed under International Financial Reporting Standards, or IFRS. Finally, we have the weighted average cost method. This approach calculates the average cost of all available inventory for sale. You simply divide the total cost of goods available for sale by the total number of units available. This method provides a middle ground approach compared to FIFO and LIFO. It smooths out price fluctuations, as it doesn't prioritize specific purchase dates. It's often chosen for inventory that is mixed together and indistinguishable, like bulk flour or sugar, where it is difficult to track individual units. Choosing the right inventory valuation method for your food business means understanding its impact on your financial statements and tax obligations. Once you select a method, the key is consistency. You generally need to stick with that method from one accounting period to the next, unless there is a very good reason to change, and that change must be clearly disclosed. Beyond simply tracking costs, these valuation methods provide critical insights. They directly influence your cost of goods sold, which in turn affects your gross profit margin and ultimately your net income. For example, knowing how FIFO can present a higher profit picture can be beneficial when seeking financing or presenting strong financial performance, while LIFO's potential for lower taxable income during inflation can be an advantage. Understanding these nuances is a hallmark of sophisticated financial management in the food industry. Mastering inventory valuation methods allows you to do more than just count stock. It empowers you to make informed decisions about pricing, purchasing, and overall business strategy. By accurately reflecting the true flow and cost of your ingredients, you gain a clearer picture of your profitability and can confidently navigate the dynamic landscape of your food business, ensuring smarter resource allocation and sustained success.